Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger. In an exclusive interview with Atlanta Fed President Raphael Bostic, he told me he favors holding rates steady in the current range of 5 to 5.25% through the end of this year, and he doesn't see cutting rates for the bulk of 2024. Bostic is towing the line between not jacking up rates too high to force the economy into recession, while also being mindful of trying to bring inflation back down to the Fed's 2% target. Take a listen to my interview.
My baseline is that we should stay at this level for the rest of the year. But implicit in that is that a lot of things are going to happen in the economy that really signal that the level we're at is sufficiently restrictive to get inflation back to its 2% target. Look, I actually think that we are still at the very early stages of our monetary policy tightening, starting to influence the economy in a significant way. And I just feel like we have a little bit of time to just let that play out and see exactly how much the economy is responding to our policy. I'll just add one other thing on this, which is that when I think about sort of my metrics of urgency, there are really two things that I'm focused on. One is the trajectory of inflation. If it starts to move away from our target and is not doing that today, then that would be a concern. And the second would be long-term inflation expectations. If I start to see that inflation expectations are starting to migrate out away from our target, that has some troubling implications for our policy and for where the economy is likely to go. And it would tell me that we definitely need to act a little more rapidly to get inflation back under control.
The market's pricing in a rate hike in July. Many of your other colleagues see 1 to 2 more rate hikes this year. It's safe to say that you would not vote in favor then of hiking in July.
Well, look, there's still a lot that's going to happen. And, so much of what people's forecasts are, what my colleagues' forecasts are, have implied answers to a lot of things that are uncertain. Are we going to see continued tightening in banking markets as we started to see through the spring? Is our pandemic era policies closing down and winding down not going to have that much of an impact on demand? Like, these are things that are going to resolve themselves in the next several weeks. I'll have a much better sense of what we need to do. But again, I do feel like we're in a position now where some patience can do us well. And look, I really want to try to do all I can to make sure that we avoid a significant economic downturn.
To your point, you wrote in that outlook that it's really been the past 150 to 175 basis points of tightening that's catapulted you, the Fed funds rate, into the restrictive territory for really the past 8 to 9 months, as opposed to 15 months that you've been raising rates. So my question is, how much of a lag effect do you think we're seeing this cycle around? Is it slower than in the past? And how much runway before you think the economy really feels the full brunt of your policy?
That's a very good question. The research says that these lags really start to reveal themselves anywhere from 6 to 24 months. That's a pretty big window. By my calculus, we're at 8 to 10 months. So we're just starting to get to the middle of that range. And I would expect that over the next several months through the summer, we're going to start to see that tightening. Now, if we don't see the economy slow down, then I would have to reconsider my position and think hard about whether we need to move forward. But I still think we're kind of still early in the game in terms of seeing our restrictive policies impacts. And I'm very comfortable waiting. But I'm a member of a committee. The committee is not there right now. We'll see what the data bring over the next several weeks.
President Bostic, how do you view credit conditions now? Do you think that the bulk of the credit tightening that we saw from the bank failures this past spring has worked its way through the system? Perhaps we'll see a little bit more on the margin, or do you think there is more significant fallout from that to come?
Well, I think there are really two things to say here. One is that the first bit of trouble happened around liquidity. And I do think that those concerns are a little lighter in my mind right now. The facilities that we've put in place, I think, have gone a long way to making depositors and banks more confident they can manage that. but there is still some credit risk that has yet to reveal itself. You know, I did a lot of work in real estate when I was a professor before I took this role. And when I talked to my contacts throughout that industry, they told me there's a lot of uncertainty about what's going to happen with commercial real estate, offices in particular. As those troubles start to bubble up, we'll have to keep a very tight eye on what happens in terms of bank lending standards and in how the sector more broadly starts to affect other types of economic activity.
You said you really want to strike a balance here, take a step back and wait. Are you worried that if you were to do more rate hikes, that could tip the economy into recession? The fact that many of your colleagues on the committee see doing at least two more rate hikes this year, does that worry you that if the committee were indeed to raise rates 2 more times this year, that would raise the odds of a recession?
Well, what I would say is this. I've been informed by history. Like my team here, they talk about economic history a lot. And when researchers and scholars look back at Fed actions, there's often been a conclusion that the Fed has always gone like 1 or 2 steps further than they absolutely needed to. And I just have that in my head as something that we should be mindful of as we think about the trajectory of our policy. Look, we have so much uncertainty in the world today. We've been through a pandemic that frankly, I didn't think we would be experiencing a month before it happened. We've had war in Russia and Europe that was inconceivable before, like through my lifetime. So we've just had one unexpected thing after another. And I do think that like just letting the world happen, our policies in a restrictive stance right now, I'm seeing signs that the things are slowing down. We're getting more into balance. Labor markets are easing. Now, all these things tell me that there's really an opportunity for us to have significant slowdown, a significant continued reduction in inflation, and steady movement back to our 2% target.
Looking at the summary of economic projections, the interest rate projections, if we look out to next year, the committee as a whole seems to be projecting rate cuts, looking at about 4.6% next year on the median from 5.6%, which would be about 100 basis points. Obviously, that would be different for your forecast, but I'm curious what your thought process is around when the Fed would begin to cut rates next year, if it would be in the beginning of the next year, and how you think about that as inflation comes down, and perhaps that gap would mean that you end up being more restrictive.
Yeah, so, you know, I would say this. I'm expecting inflation to come back to target in a very measured way over the course of an extended period of time. Our history has told me that the first part of inflation reduction can come relatively easy and actually not even that fast, but relatively easy. And now we're at the part where we've got to see services inflation start to decline. Wages in those sectors are stickier than in other parts. And so it's just going to take a bit longer for inflation to get all the way back down to the target that I expect. So I don't have a rate cut in my forecast, in my baseline forecast, for the most part of 2024. I think we'll have to just let inflation take its time getting back down to our target. Our policies, I think, are strong enough to make that happen. And, you know, we'll just let the experience tell us. Now, this is all, again, on baseline, right? And if the economy were to remain stronger than I expect, then, of course, I would have to consider accelerating or changing my stance in terms of how restrictive we need to be. But again, that's not what I'm expecting to see happen. And we'll just have to see where the world takes us.
Of course, of course. Switching gears, President Bostic, the Federal Reserve released financial disclosures for regional bank presidents last week. And you disclosed as part of that a third-party money manager bought and sold exchange-traded funds on your behalf on May 2nd, 2022, during a blackout period, just days before a policy meeting. Are you aware of these trades that are being made on your behalf?
Well, look, I've said a lot about this in disclosures both this year and last year. The most important thing is that they have been corrected. Those sorts of trades should not happen anymore. And I really can't say much more about that in terms of detail because this is being investigated by the Federal Reserve Inspector General, and I want to let that inspection play itself out, and we'll just see where we are at that point.
Is there anything you're looking to do to make sure it doesn't happen again in the future?
So I've already done those things, and I'm not expecting we'll have this as an issue moving forward.
And my big thanks to Atlanta Fed President Raphael Bostic.